When you say disciplining non-OPEC supply, are you talking just about shale or everything else? Who are you talking about?
Mostly US shale, because US shale is the short cycle, the short-term producer that responds within a year or so to price changes. Supply elsewhere in the world is mostly long cycle, where you're also price elastic, but it takes typically many years. Taking a step back, I think over the last 2 years, OPEC has really been quite effective at balancing the market by adjusting supply and to keep prices in a fairly narrow range by historical crude standards. If OPEC goes ahead with raising production, and it's very much a close call, we may learn more in coming days, we may potentially shift to a new equilibrium with somewhat more volatility, where the new floor under oil prices becomes the break-even price of US shale producers.
Let's go back to the experience of the last decade, the middle of the last decade. There was a real effort from the Saudis to discipline and almost punish shale producers. Arguably, shale producers came out of that more disciplined and much stronger. What's different about this time compared to then?
So I think, as you point out, US producers have very strong balance sheets now. The reinvestment ratio is significantly lower. About 50% of free cash flows are reinvested in new projects. And so I think that means that to engineer a given slowdown in US shale growth, you arguably need a bigger drop in prices, because those big US public producers, their production plans, they're fairly sticky, and they're very strong balance sheets. And so to us, that means that a very sharp drop in prices is not that likely. It's more likely going to be a gradual shift lower.
Some people would argue that just structurally what you see right now is you haven't seen that increased production by OPEC Plus, and what you've seen is actually inventories getting taken down at 8 out of this past 9 weeks, this according to some industry data. I'm just wondering at what point you see this as kind of feeding on itself, especially with lower rates that might sustain the recovery. How much of a counterpoint do you really take to this?
Absolutely. So we only have a modest and gentle decline in oil prices next year, from Brent sort of in the high 70s now to $74 per barrel by the end of next year, despite a moderate but meaningful surplus we have in our balance next year. Why is that? Only slightly lower prices despite this surplus, we assume. The main reason is that we do think that oil currently is slightly undervalued, meaning that prices are a touch low relative to the level of inventories. And also, if you do get these Fed cuts, you should get some upward pressure on valuations and prices, because basically the opportunity cost of holding oil is lower when interest rates come down.
So I apologize in advance for this, but your predecessor, Jeff Curry, who now is at Carlyle, came out yesterday and he said there's going to be a huge spike in crude prices because of lower rates and because of this sort of super cycle that you see on the heels of the investment in some of the infrastructure plays that we've seen globally. Why do you so vastly disagree with that?
First of all, I would like to thank Jeff for everything we and our team learned from him. It's very much building on the shoulders of a giant. And I agree with Jeff that positioning is very low, is very light at the moment. And I also agree that oil prices currently look somewhat low relative to fair value. And that's precisely the reason why, despite a meaningful 600 KBD surplus in 2025, we have a base case of only slightly declining oil prices.
77 is the average for 2025, correct?
Correct.
How much of that is about Chinese demand softening and maybe not bouncing back?
I think that the big surprise this year on the demand side has been softness in China demand growth. Actually, it's demand outside of China is surprising to the upside, in the US, in Europe, in India. But I think the slowdown in China demand growth, which is, I think, mostly structural, is an important factor for oil markets in coming years. To put this in context, in the 5 years before COVID, China was growing its demand of oil by almost 600 KBD every year. In the first half of this year, annual oil demand growth from China was only 200 KBD. So basically only 1/3. Some of it is a macro story. GDP is structurally growing at a slower pace. But some of the factors are oil specific and more micro. Fuel switching into EVs. Fuel switching out of diesel into liquefied natural gas, which is now cheaper as well. And we think that some of those fuel switching factors are more structural.
Are we seeing that in other commodities as well? We're starting to see that in, say, iron ore versus copper, too, in China.
So I think that the sort of 2000s China-driven commodity supercycle was a supercycle where very rapid growth in China GDP and especially the property sector, sort of lifted demand and prices for all commodities. I think we're going to enter an era with greater divergences in terms of the demand trends across commodities, with, I think, a pretty solid long-run demand outlook for copper. It's the green metal of the future. Gold, because I think Chinese, including central bank, are looking for new assets in a more uncertain world. But then on the other end of the spectrum, iron ore, ferrous metals, where I think the demand outlook looks bleak because of a structural grind down in demand in the property sector.
This was an absolute clinic, and we've got to do it again soon.